Hello and welcome back to my channel. You're welcome to Finance with Dr. Ish. My name is Dr. Ish, ex-banker and finance strategist. And on this channel, I'll break down how money really works without any hype, shortcuts, and of course, confusion. So, in today's episode, we'll be talking about high yield savings accounts, and I'll be comparing how they work across the United Kingdom, that is the UK, the United States, and Nigeria. Now, a lot of people hear phrases like 5% interest, high yield, or passive income, and very few actually understand what is real, what is safe, and what applies to their country. So in this video, it's not about chasing the highest number. It's about understanding the system so you can make smarter, calmer money decisions wherever you live. So we are going to start from the basics. And like I always say, you do not need to take my word for it, but this is me here opening your eyes to more investment opportunities, how to handle your money smarter and more strategically and intentionally. But of course, the onus is on you to do your own due diligence and research and find that which works for you. This is really key and very important when you want to move or start your investment journey, or if you are already on your investment journey. So the first thing we're going to be talking about is high yield savings account. What is a high yield savings account? And it simply means a savings account that pays more interest than a traditional savings account that many of us are used to. And in most countries, traditional banks pay almost nothing. We all know that. That's the reality currently. Sometimes they even pay less than 1% with all your money saved there. Imagine leaving your money in your savings account for so long and all you get is less than 1%. That's practically almost nothing. However, high yield accounts usually offered by online first banks or digital financial institutions because they have lower operating costs. So because they have lower operating costs, they have the tendencies of operating more yield or more interest on the accounts you open with them. And many of these accounts have no minimum balance. They charge low or zero fees and allow easy transfers in and out. But here is the important part, and this is where people get confused. A high yield savings account is not an investment. It is still a cash product. I repeat, a high yield savings account is not an investment. It is still a cash product. Its purpose is capital preservation, liquidity, that is you having easy access to your money, and modest growth, not wealth multiplication. So once you understand that, everything else becomes clearer. So as usual, we'll be starting from UK, which is the current landscape. And right now, some of the top high interest savings accounts in the United Kingdom are offering between 4 to 5% and about 5.2%. It varies depending on the kind of product. These are mostly offered by digital or challenger banks like Chase, UK, Zopa, and Atom Bank. Now, here is where many people miss a major advantage, right? The individual savings account, when you use a cash ISA, the interest you earn is tax-free. That means a 5% return inside an ISA is actually more powerful than a higher rate in a taxable account. So from a banker's perspective, The UK system rewards people who understand allowances, split savings across providers, and use tax efficiency as part of their strategy. So the goal here isn't just the rate, it's what you keep after the tax, I mean. So you have to be very, very careful because basically based on what I've written, top accounts offer between 4.5 to 5.2%. And this is just, I'm not saying this is all you can get, but just first top of mind recommendation is Chase UK's offer at Home Bank, right? And of course, you have to also make sure that regulatory bodies are also protecting these cash products. Very, very crucial. So we'll be moving next to the US. We're going to be looking into the United States. Looking at the US, high yield savings accounts are very common, and the rates currently range from about 4.8% to 5.25% APY. Now, popular providers include Ally, Sophie, Capital One, and American Express. They are not the only ones, but like I said, top of mind. And this is just the basic. We're not breaking them down we're not making them too complicated. I want them to be easy for you to understand. And like I always say, ensure you do your own research. I'm just opening your eyes to other options of high yield savings accounts and of course investments based on other videos I've done, so that depending on your location, the location where you live in, or if you wish to be in one location and invest in another country, you already have an idea of what you're looking out for. Now, so one key strength of the US system is FDIC insurance. Remember, I'm always talking about regulatory bodies and security. That is number one pointer any asset manager or banker would be looking into for investment. Now, your deposits are insured up to $250,000 per bank per depositor. So from a banker's viewpoint, this makes high yield savings in the US extremely suitable for emergency funds, short-term goals, and cash to be invested. However, interest in the US is usually taxable. So again, what matters is not just the headline rate, but the net return after tax. Invariably, what I'm telling you is that the UK and US usually are prone to high level of tax. And if you look to investing in any of those countries, remember that what you're looking at is, okay, after my investment and after tax has been applied, based on my profit, what is left. So that is what will help you to determine if the investment itself is worth it or not. So if it is not worth it after the tax, it depends. Some people would not mind however little that comes to them after tax. And like I always say, when it comes to investment of any sort at all, either is a cash product or short-term or long-term investment, the major focus here is to make sure that the entire amount you're investing in should always come back to you, separate from the profits that you're going to get. So the first concern is, am I getting the entire money I invested or put in the bank back without any loss? Before you now talk about, okay, what is the profit I'm going to get and what is the level of tax that I'm going to be exposed to. So Nigeria works a little differently. So what people call high yield savings in Nigeria is usually found through fintech platforms or money market funds rather than traditional banks. So examples include Carrywise, Piggyvest, ARM money market funds. There are quite a lot of them, but like I said, top of mind, and just to guide you on what to look out for. So returns typically range from 8% to 15% annually. But it's important to understand that these returns are not fixed. They fluctuate based on one, interest rate environment, two, treasury bill yields, three, market liquidity. So from a banker's lens or point of view, Nigerian savers must pay extra attention to liquidity inflation, and the platform structure. Because high returns means nothing if inflation will quietly erode or take away your purchasing power, and at the end of the day, the money will be, the profits will just be sort of useless to you, right? So what I'm just saying that regardless of the country we are analyzing here, you need to be able to look at these basic factors. And the first is compound interest. How often is interest added? Is it daily? Is it monthly? Is it yearly? Compounding frequency matters more than people realize. Don't take it for granted. Second is withdrawal rules. You know, I'm always keen. Most of my videos I always say how you put the money in matters, and how you also get that money out if there's an emergency also matters. So some accounts limit, you know, how often you can access your money without penalties. So at the end of the day, you don't want to be withdrawing money consistently and get penalized for withdrawals and then lose all your interest. Third is inflation adjusted value. If inflation is higher than your return, your money is technically shrinking. It's of no use. Even if the number keeps going up, inflation is eating into the value of that money. So smart saving is not emotional, it's mathematical, it is strategic. You need to do your 1+1, your 2+2, and all that matters. There are key points, as I've earlier mentioned in other slides, you need to take into cognizance before you decide where to invest your money. So what is the smart strategy here? In the UK, use cash ISA and split funds across providers to stay within limits and optimize your returns. Remember what I said about tax? And in the US, use high yield savings primarily as a cash buffer, emergency funds, short-term needs, and money waiting for investment. And in Nigeria, diversification is key, right? Combine money market funds, fintech savings, and fixed deposits in a structured way. The principle is the same everywhere. Don't put all your eggs, or should I say all your cash, in one basket. So always compare your interest rates, be mindful of that, and withdrawal terms. A slightly lower rate with flexibility is often better than a higher rate that you cannot have access to. Please take note of that. All right. So very, very key. I've mentioned the basics, and as usual, I'm waiting for you in the comments. Any questions you have, I'll be glad to respond. Any other ideas you may want me to expatiate on, or any gray areas you feel you need me to explain better on, I'd love to hear from you in the comments. And as usual, please do not forget to like, comment, and of course subscribe and share this with other family members who need to learn how to invest wisely, either in the UK, in the US, and in Nigeria. And I will be waiting to hear from you, and of course I will see you in the next video.